Welcome back to the Finance Files. As always, this is just for entertainment purposes. It is not investment advice. And today is Way Back Wednesday. Brit, do you want to kick us off with a little history of investing?
Yes, and this is probably going to be my favorite episode every week because I just love nerding out on history. Sorry if you're not a history nerd. But I do think what's cool about looking at history is you're able to see why does this exist and understand what the real fundamentals are of it, right? Versus today and in the past. So investing, a lot of people think it started in 1602 when they had the first Amsterdam Stock Exchange, but the concept of investing actually began back 3000 BC when farming began. And I was trying to figure out what was the impetus between, like, the human civilization's been around for tens of thousands of years, or not civilization, but humankind. What was it about being an agrarian society? And I realized it's this concept of time. And I love this because Whitney and I have been talking about what next week is going to be about, and it's going to be all about time. And that really is a key discerning factor between bartering and investing, right? And so investing is all about trading that time for a greater reward. So back then, the farmers would say, hey, I've got these seeds, front me some money and I'll grow them. And then you'll either get some of the food or I'll sell the food and then I will pay you back. So that is how this all started, the general concept of investing. And if you get at the core tenet, the idea is you have something that needs time, it needs resources and energy. And in a future date, it's going to be worth way more. So you're willing to put money in that with the expectation that you will have more in the future. So I think that fundamental principle really ties into the investor mindset and this whole concept. And now I'm kind of done with my little nerd spiel. And on that note, Greg, I would love to hear from you. You've been an investor for decades. How do you feel investing has just changed over time, and then what has also stayed the same?
Okay, sure. Well, one of the things that I'm constantly amused by is the concept that this time it's different. And I've yet to see in my 40 years of investing for something to really be different. It always ends up being, a pattern that you've seen before. Markets are always going to be volatile. There's always going to be crashes when things go to excess. Things always go to excess. And, we end up in a recession and then we come out of the recession. And so it just is a constant cycle that you see over and over and over again. The things that have changed, the ability to trade has gotten dramatically easier. I'm going to date myself here now. When I first started out, you had to call a broker if you weren't a member of one of the exchanges, who would then relay that order somehow down to somebody on the floor who would run over to the specialist post and execute your trade. Or if it was an option trade, same thing. They'd have to go over to wherever those options were traded and negotiate with somebody to buy those or sell those options.
How long
Now,
did that whole process typically take?
for the access that we always got for the places that I worked, it was always fairly quickly. I mean,
Okay.
it would be typically within a minute. However, the crash of
Wow.
'87 was wildly different. I mean, you couldn't get people to pick up phones, period.
Yeah.
So,
Wow. Wait, so that's interesting because that's almost like saying, hey, the big banks almost had more of they had an advantage. We were talking about, like how the big banks, they've got like all these algos and all these resources. They kind of had advantage then too, because if they had someone on the floor, they could make those trades a lot more quickly, right?
yeah, they still had to call their guy and he still had to run over to the post, but they could make the decision and trade, whereas we'd make the decision and have to pick up the phone and then tell them to make the trade. So the lag wasn't too bad on a practical perspective, but as far as algo trading, it was like eons of time because now everybody's worried about nanoseconds. So
Wow. How long did it take for like average Joe to be able to execute a trade?
I would guess to get a report back on a trade, 10, 5 to 10 minutes.
Yeah.
Um,
So, Time is money, right?
Yeah. Well, and if you're,
Okay.
if markets are reasonably stable and you're doing a medium to long term investment, that 5 to 10 minutes really isn't going to mess things up. It's
Right.
only in volatile markets, or if you're trying to, day trade something, that becomes a real problem.
Right.
Yeah, which we will get into on tomorrow's episode, which is fun. But yeah, so that's really interesting. Do you think that how, because I think about way back when, and a lot of people had pensions, and it was just kind of a whole thing, whole different ball game in terms of how the everyday middle class person needed to prepare for retirement. Do you feel like there's been any changes in terms of how the person who isn't a full time investor approaches investing?
Well, the expense of investing for the non full time investor and for the full time investor has come down dramatically. Back in the day that I'm talking about, the minimum bid ask spread on a stock traded on the New York or the American Stock Exchange was 12 and a half cents.
Whoa.
Now
For
you're
comparison, what would a typical bid-ask spread be now?
a penny or less.
Yeah, crazy. Versus 12 cents was the
Yeah,
average.
yeah, yeah. 12 and a half cents or an eighth. And then
Wow.
on top of that, you had to pay a brokerage commission, which just barely became deregulated when I got involved. Up to that time, it had been a fixed schedule that all brokers charged, and the exchanges enforced that, which was a healthy percent of what you bought or sold. Now
Interesting.
you can do it at very, very small costs. There's also brokers who quote unquote do it for free, and the reason I say quote unquote is you're still paying a cost. It's just buried in the execution, because what they do is they sell your order flow to, like, Citadel, for example, who is counting on trading against you and making money.
Okay, so this time is not different. As how do I as an investor incorporate that into my investor mindset and use this time is not different to my own advantage?
Well, be cognizant that technology is always going to improve our life. Technology is always going to, in essence, be the forefront of where the markets go. Be it, whether it was having a better railroad schedule back in the day, or, being able to call long distance for less than $1 a minute. Today, everybody's all worried about artificial intelligence, and that's obviously going to be a part of our lives going forward. And I'm sure there'll be some very smart people that'll figure out how to make a lot of money using AI or providing AI to us. So technology always has an advantage in that there's always new stuff and a better way to do things. And so if you're investing intelligently in broad swaths of technology, you're going to tend to make money.
I really love that you brought up the fact that there will always be recessions, and will always be times where things get hyperinflated. Because I remember when I like just graduated college or whatever, we're like in this recession. It seemed like such a novel concept to me, this like the idea of a recession. I just assumed recession is bad, and then you realize it's actually almost more of a correction, right? It's where the market's correcting itself. And it's actually, I was listening to this thing, and we have this recency bias. It's actually very normal to have recessions.
Right. Yeah. It's and the other thing that people, of your age, that you have not experienced is what real interest rates are like. Because you're
Very excited about. They're like, you did not live in the 80s.
no, I mean, when I first went out on my own, interest rates were, for the prime rate that banks would use in calculating what you're going to loan, they were 18%.
Whoa.
I mean, mortgages were higher than that.
Well,
So
to be fair, the cost of a home, like maybe you can afford a little more interest if, the home's not going to cost your entire life savings and your firstborn child.
Right.
But yes,
Right.
14, I mean that's wild to think that the interest rate was
Yeah.
that high.
Yeah. Yeah. And you know, a 6% mortgage rate back in the day was considered a really cheap mortgage.
Meanwhile, today we're all balking at, a 6 to 8% mortgage rate.
Exactly.
So, yeah,
Yeah.
it's all
Yeah.
relative. Well, and even like the pandemic, right? Everybody was like, these are unprecedented times, this has never happened. And it's like, well, no, pandemics have happened. We've just, us in our lifetimes, we've just never experienced a worldwide pandemic, but it happens.
Well, and
Right.
honestly, of all the times to have a pandemic, we looked out so hardcore. We were able to go on Zoom and talk to people. We had, and like, bless all the delivery drivers. We had Amazon. There were so many benefits. Like, I would much rather have this than the Spanish influenza that, took people out like way back when.
Well, and I think that underscores the importance of technology, right? There were a lot of technological advances that happened because of the pandemic, and if you were smart enough to invest in some of those early on, you probably were quite successful with those
It's fu-
investments.
it's funny you bring that up because and I'm not going to remember the exact numbers right now, but someone was like, "Oh yeah, if you invested in Logitech, because it's almost like they said like for the gold rush, like look who's selling the pickaxes." Like I think people like flocked to like the, Facebooks of the world stuff, which don't get me wrong, they got great returns and then just completely slammed once which completely slammed once the pandemic was over, but like Logitech, like all these different at home devices that were needed to work from home crushed it. And what's crazy too
Right.
is work from home, I mean it's definitely switching, but a lot of people still have work from home setups. So those companies are still benefiting from that general tech shift.
Yeah, great point, Britt. So, Dad, what are some other things when you look back at your time working for these billionaires? What were some takeaways on the investor mindset from a historical perspective?
Sure. Well, as I mentioned previously, um, you know, my experience with those people have been that they're very conservative in their investment. They're not looking to get phenomenal double digit, high double digit, triple digit returns. They're mostly concerned about preservation of capital. And I quoted Will Rogers, I'm not so concerned about the return on my investment, but the return of my investment. And been a pervading philosophy that I've experienced in the various family offices that I've worked at, in that we always want to understand very clearly the risks. How do we mitigate those risks, and the risks that we can't, get rid of? Are we comfortable with that risk, and is that risk commensurate with the expected return of the investment?
Do you think that taking a historical look at, okay, historically, what has been the risk for this type of investment? Do you think that can be informative when making an investment decision?
Sure. Yeah. I mean, it's always good to understand on an individual stock how a stock responds to different kinds of news. Stocks that have been trading for a while, there are going to be times when they disappointed on earnings. There's going to be times when they surprised on earnings. And so you can look back over a chart, and if you know when those different events occurred, you can look and see how the market generally responds to that. Now, is that a guarantee that it's going to do it next time? Not necessarily, but it's probably a pretty good indicator.
Yeah,
The other thing, though, that you've got to be cognizant of is there will be news events in stocks that you didn't anticipate. And
Such as, what's an example?
well, a CEO can resign unexpectedly, or there can be, some sort of malfeasance somewhere.
Okay.
You may have a division that forgets to bolt the airplane doors on, things like that.
I think too, if you look at, for me, coming from being an industry analyst, looking at the industry as a whole, not just the company specifically, is so helpful for understanding the volatility of an investment. So, for example, I covered the boat building industry when I was an analyst, and during the recession, the entire industry contracted in half. I mean, there is volatility in a lot of industries, but to literally, I mean, major players were bankrupt. Like it was a big deal. So sorry for the boating aficionados that were so excited to invest in a boating company. Like, maybe that's still a fun opportunity. I'm sure there's some new technology that some of them are coming up with that's exciting. But if you're trying to conserve your investment, it is a relatively volatile industry. So, yes, you're going to want to look at this company specifically, but also if you can just take a broader look at how that industry does during the economic downturns, like Greg said, there's always going to be a recession. How do you protect your investment portfolio against the economic changes?
And for the passive investor, the one that's not worried about picking stocks, and I have a son who doesn't have any interest in the market other than he wants to be invested. My advice to him, which he has done, is he's picked a fixed amount that he invests in the S&P 500 every single month. And by picking that fixed dollar amount, when the market is high, he's investing less. And when the market is more, he's buying more of it because his dollar quantity that he's investing is fixed each month. And he's of an age where, between now and the time that he retires, which is many, many decades away, he doesn't need to lose a lot of sleep over, is the index going to go up over the next umpteen years? Because it will probably go up.
Yeah, there's so many books that talk about that, how it's historically just always, outperformed a lot of more select stocks. And we'll get more into retirement next week, but now it's time to wrap it up. Whitney, you want to send us off?
Sure, yeah. So, for this Way Back Wednesday, we talked about bartering versus investing, how that started, and the importance of focusing on the return of your investment, not just the return on your investment. And taking a historical look because this time is probably not different. So join us tomorrow for Think Like an Investor Thursdays, where we're going to talk about how to think about investing and specifically what an investor is.